This is John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, March 29. To view our full range of publications, visit www.investingdaily.com. Stocks soared Friday to close the week higher, with the Dow Jones Industrial Index and the S&P 500 hitting record highs. The Dow jumped to nearly 454 points Friday as economically sensitive stocks rallied amid economic reopenings. Signs of rising inflation, higher bond yields, the lingering pandemic. Investors are shrugging off the risks. For Wall Street, it's damn the torpedoes, full speed ahead. Even a curmudgeon like me must admit that the economic backdrop is encouraging. After a pandemic-battered year in which the stock market ran ahead of economic fundamentals, the recovery is starting to catch up with equities. With the one-year anniversary of the market bottom this past week, stock market performance over the last 12 months has been exceptionally strong. The market rebound has been powered by expectations for the economic recovery and a commensurate rebound in corporate profits. The following table tells the story. Take a look. U.S. gross domestic product is on track to return to pre-pandemic levels this year. The rally will derive fuel in the coming months from the lifting of lockdowns, vaccine rollouts, monetary and fiscal stimulus, and improvements in the labor market. To be sure, the threat of inflation has increased and interest rates are climbing higher, with 10-year Treasury yields at a 14-month high. Nonetheless, the Fed has promised to keep the monetary spigots open, even if inflation temporarily rears its head. The unequivocal good news is on the earnings front. As the end of the first quarter approaches, 94 S&P 500 companies have issued earnings per share guidance for the quarter. Among these 94 companies, 34 have issued negative EPS guidance and 60 have issued positive EPS guidance. Take a look at the second chart. The number of companies issuing negative EPS guidance is well below the 5-year average of 66, while the number of companies issuing positive EPS guidance is well above the 5-year average of 35. Earnings growth is projected to be strong for the rest of the year. Meanwhile, the jobs picture has brightened as well. The U.S. Labor Department reported Thursday that the number of new applications for unemployment benefits dipped below 700,000 in late March for the first time since the coronavirus outbreak. See the third chart. Initial jobless claims filed through the states fell by 97,000 to 684,000 for the week ended March 20, the lowest level since March of last year, underscoring the strength of the economic recovery. The stock market rally in recent weeks has shown broader shoulders. In 2020, a handful of U.S. mega-cap technology brand names accounted for a disproportionate share of market appreciation. As the economic recovery accelerates this year, sectors and asset classes that have lagged are picking up the pace. We're in the early to middle stage of economic recovery. The following graphic shows you the appropriate sectors for each stage of the economic cycle. Specifically, the rally is broadening to include small cap and international stocks, as well as economically sensitive cyclical sectors. I expect inflation and interest rate fears to generate greater volatility, but they won't pose enough of a threat to undermine the economic recovery and bull market. I'm not ruling out pullbacks along the way, of course, but you should view pullbacks as buying opportunities. To help you fully leverage the accelerating economic recovery, our investment team has put together a special report. It's called 5 Red-Hot Stocks to Own in 2021. In this report, we provide the names and ticker symbols of the highest quality stocks to buy for this stage of the economic cycle. For details, consult the article that accompanies my video on the Investing Daily website. Well, that should do it for today. If you have any questions, don't hesitate to send an email to mailbag@investingdaily.com. Thanks for watching and see you next week.